Welcome to The Explainer. Today we're launching a massive deep dive investigation into a company that has literally taken over the financial world. You know them, I know them, NVIDIA. We're setting out to answer one primary question today. Is a company worth trillions of dollars still an exceptional investment right now, or is the market already priced in way too much of our AI future?
Just think about that number, $5.4 trillion. That is NVIDIA's recent market capitalization, and honestly, it's almost absurd. But as an investor, you really shouldn't look at this massive number as a victory lap. You've got to look at it as a problem of gravity. Because when a company gets this enormous, generating nearly $100 billion in a single quarter, the central problem becomes how on earth can it possibly keep growing fast enough to actually justify that massive price tag?
And this is exactly why there are two completely different ways investors are looking at this stock right now. On one hand, you have the AI bull, right? They see the absolute most powerful infrastructure company in the world where demand is vastly outstripping supply. But then you have the value bear, who looks at this and sees a $5 trillion behemoth that now has to produce extraordinary logic-defying growth just to maintain its current price. Honestly, asking did NVIDIA beat earnings this quarter is actually the least interesting question we can ask. The real question is whether its future cash flows will turn out to be worth more than the insane premium price you are paying today.
Okay, let's dive right into this. We've structured this explainer as a step-by-step dossier. We're going to start with the $5 trillion question, then follow the money, look at the customer threat, examine supply and China risks, map out 3 possible futures, and finally deliver a verdict.
Section 2. Following the AI money. Let's hunt down exactly where that revenue is coming from.
So if your mental model of NVIDIA is still just a company that makes graphics cards for gaming PCs, well, it is time to completely throw that model out the window. 92% of their revenue, that is $89 billion in a single quarter, now comes straight from their data center segment. When you buy NVIDIA today, you are absolutely not buying a gaming company. You're making a direct, concentrated bet on the continued, massive build-out of global AI infrastructure.
And we can see exactly where all that infrastructure money is pouring in from. The 5 largest cloud companies, we're talking about the hyperscalers, are expected to spend approaching $800 billion on capital expenditures in 2026, and that ramps up to a staggering $1.3 trillion in 2027. To put that into perspective, that is a mind-boggling amount of cash. The story here isn't just that everyday people are using more AI chatbots. The real economic story is that the world's biggest tech companies are frantically building out physical, massively power-hungry infrastructure to run AI at an unprecedented scale. And NVIDIA? Well, they're standing right at the toll booth.
Now, this tidal wave of spending has given NVIDIA incredible operating leverage. Their revenue recently grew by an astonishing 106% year over year. But their net income actually grew even faster, hitting 126%. They are insanely, ridiculously profitable. But this brings us to a really uncomfortable question. If NVIDIA is already generating nearly $100 billion a quarter, hitting peak operating leverage, where in the world can the next massive wave of growth possibly come from to push that stock price even higher?
Which leads us to Section 3, the customer threat. This one is hiding right in plain sight.
Deep inside NVIDIA's SEC filings, there is this fascinating little clue. Just one single direct customer accounted for 16% of NVIDIA's total revenue. Think about that for a second. We're talking about tens of billions of dollars totally reliant on one single relationship. For a company of this sheer size, having this level of revenue concentration introduces a massive structural risk.
Now, what's really interesting here is the dynamic at play. The more successful NVIDIA becomes, the more expensive it is for their giant customers. Players like Amazon, Google, Meta, and Microsoft. These companies have practically unlimited budgets and some of the absolute best engineers on the planet. They have every financial incentive in the world to just design their own custom AI chips. So NVIDIA's biggest risk isn't necessarily a direct competitor like AMD. Actually, it's the slow, quiet migration of workloads to custom silicon built by their own biggest customers to save billions of dollars.
And you know what? NVIDIA absolutely knows this, which is exactly why they are trying to change the rules of the game altogether. They reportedly agreed to acquire the open-source AI platform Hugging Face for nearly $13 billion. This isn't just some hardware company buying a software tool. Not at all. This is a defensive moat. NVIDIA wants to become an inescapable ecosystem. They don't just want to sell you a chip. They want developers so locked into their software and platforms that switching over to a custom chip becomes economically and technically painful.
Okay, moving on to Section 4, Supply Chain and China Risks. Let's talk physical realities.
So demand for AI chips is obviously off the charts. But remember, NVIDIA doesn't actually manufacture all these chips themselves. They rely heavily on TSMC and advanced memory suppliers, and man, those supply chains are incredibly tight right now. Because component costs are rising, NVIDIA actually expects its gross margins to drop from a pristine 75% down to around 71 or 72%. Now you might think, oh, that's just a few points, but for a company generating tens of billions in revenue, a drop of just 3 or 4 percentage points literally equals billions of dollars in lost profitability.
Then there is the giant geopolitical elephant in the room. In their recent mega quarter outlook, NVIDIA assumed absolutely zero advanced data center revenue from China. Zero. And this is entirely due to U.S. export controls. Now, on one hand, it's actually incredibly bullish that they can sit there and forecast $108 billion in a quarter without relying on the Chinese advanced data center market at all.
But there is a much deeper, far more subtle danger hiding here. As the company itself has warned, being shut out of China doesn't just mean lost sales. It essentially forces Chinese tech giants to build their own powerful ecosystems completely independent of NVIDIA. Basically, it creates a massive, well-funded laboratory for competitors to develop and refine alternatives. And that could pose a severe global threat to NVIDIA's dominance just a few years down the line.
All right, Section 5, 3 possible futures. Let's solve this valuation puzzle.
So the crucial point here is that valuing NVIDIA requires us to look at a few different realities. Let's just walk right through them. In Scenario 1, the AI supercycle continues. NVIDIA hits its 70% growth targets, and they basically just grow right into their massive valuation. Awesome. But look closely at Scenario 2, normalization. Here, NVIDIA remains a phenomenally successful company, but growth slows down to a more normal, say 15%. When that happens, the stock suffers from what we call multiple compression. Basically, investors stop paying a massive premium for hypergrowth, and the stock price drops significantly, even though the company is still doing great. And then there's Scenario 3. The Capex break. This is where tech giants realize AI just isn't making them enough money, spending collapses, and the stock gets absolutely hammered.
Which brings us to our finals section, the final verdict. Let's piece this whole puzzle together.
If you are going to invest in a company that is this heavily scrutinized, you need an actionable checklist of exactly what would break the investment thesis. These are your red alerts. Watch out if the big tech hyperscalers actually cut their AI budgets instead of just slowing their growth. Watch for a structural, ongoing drop in gross margins, proving they've lost their pricing power. And most importantly, you've got to pay attention if custom silicon from Amazon or Google actually starts taking over significant real-world workloads, or if developers start abandoning NVIDIA's CUDA software. These are concrete warning signs, not just everyday market noise.
Conversely, identifying a true buy signal requires incredible discipline. You shouldn't buy just because the stock dipped 5% on a random Tuesday, right? You need a combination of intact, proven AI demand, stable profit margins, and most importantly, you need to see analyst earnings estimates continuing to rise to actually justify the price. Don't fall victim to momentum psychology, jumping in purely out of the fear of missing out.
Ultimately, your personal verdict entirely depends on what kind of investor you are. If you're a long-term growth investor, NVIDIA remains a selective buy or a strong hold. The fundamentals are undeniably extraordinary. But if you are an income investor seeking dividends, you need to completely avoid this stock. With a yield of just 0.44%, NVIDIA is using its cash for share repurchases and massive R&D, not for paying you a meaningful quarterly check. It's just fundamentally the wrong tool for an income job.
And that brings us to the core philosophical takeaway of this entire investigation. NVIDIA is a brilliant company, but at a $5 trillion valuation, the market is essentially priced in years of absolute perfection. The greatest risk you take right now isn't that NVIDIA suddenly becomes a bad business. It's paying a premium price that mathematically assumes absolutely nothing goes wrong over the next 5 years. They don't just have to be great anymore. They have to consistently beat increasingly enormous expectations.
So I want to leave you with this final provocative thought. Don't ask if they beat earnings. Ask yourself this. If NVIDIA actually manages to pull off 70% growth again next year, how much upside is truly left from today's massive price? And more importantly, what happens to your hard-earned money if that growth inevitably falls back down to reality? In investing, that dangerous gap between sky-high market expectations and long-term business reality is exactly where fortunes are won and lost. Keep your eyes on that gap. Thanks so much for joining me on this explainer, and keep learning.